Good morning, everyone. Welcome to the inaugural Cantina Summit. We're very excited that everyone made it here today, bright and early at a hot day in New York. We're at a crucial inflection point in the financial services world with blockchain, and today we are exploring that. We've brought together leading voices across traditional financial institutions, Web3 organizations, and regulatory bodies. And today we'll be discussing the convergence of these two financial worlds. So our first panel is going to be discussing what the next decade could look like at the intersection of financial services and blockchain. And I'm excited to announce some really amazing guest speakers. We have Rahul Goyal, the head of institutional partnerships at Gauntlet, Sid Ramesh, who leads Coinbase's Bitcoin-backed loans, Kevin McCordick, aka the intern and head of growth at Monad, and Sharon Itaguchi, one of Cantina's very own. So without further ado, I'll let the panel begin.
Awesome. Thanks, Mike. So we are coming to the end of the first decade of on-chain finance. So what we're going to be talking today is about what's next, which is why we're happy to have both representatives from OG blockchains as well as institutions, well-known institutions in the room today. So with that being said, I would love to get started with brief introductions from each of you so everybody knows a bit about your background and what you handle. And then from there, we can hop into some of the questions. So Rahul, if you want to go first.
Yep. Can everyone hear me? Is this working? This is on? All right. Hey, guys. Thanks for having us. Sharon and the whole Cantina team, really appreciate it. My name is Rahul Goyal, the head of institutional partnerships here at Gauntlet. Been here for about 3 years. And before that, spent about a decade in TradFi across a lot of major firms like BlackRock, JP Morgan. Just 30 seconds on Gauntlet quickly. Gauntlet was started in 2018. We worked with some of the largest players in the crypto space, like Coinbase, Circle, Uniswap, Eigenlayer, Morpho. And over the last year or so, we've taken a lot of this expertise and now more directly manage assets on chain. So we have about $750 million across a number of different strategies, a number of different chains. And over the last few months, I helped lead a new product that we launched, the levered RWA product, which I can talk a little bit more about later, in partnership with Apollo, Securitize, and Morpho.
Hey, I'm Kevin McCordick. I'm head of growth at the Monad Foundation. Initially started working full-time in crypto in 2020 at a firm called CMS Holdings, doing venture investing in startups in the space. Initially found Monad as a deal that came across my desk at CMS and joined the team there shortly after. So I've been working at Monad for right around 2.5 years. Monad, for anyone who is not familiar, is a very scalable, decentralized layer 1 blockchain, fully EVM compatible, and looking to launch mainnet in the very near future.
Hey guys, I'm Sid Ramesh. I'm a product manager at Coinbase. I joined Coinbase about 2 years ago. Prior to Coinbase, I was mostly in startups and kind of DeFi-focused products. So I guess like 2018 was involved with a company called Dharma, where we actually did one of the first, I would say, DeFi lending apps. Worked at a number of different companies, kind of sort of in the DeFi trajectories from 2018, and also was part of a venture fund called Nascent, where we invested in a lot of early stage startups. And joining Coinbase, at Coinbase, I focus on our Bitcoin-backed loans product. It's one of the first products where we integrated DeFi at scale. So it's Coinbase in the front and DeFi in the back, where we integrated Morpho. Excited to dive into some of those topics in the panel.
Awesome. Appreciate it. So to get things kicked off here, I think we would love your take on what the benefits of on-chain finance are. And from your perspective, is it primarily about cost reduction or opportunity expansion? Rahul, why don't you get us started again?
Yeah, for sure. So, I think the answer really is both. Most of what we focus on is more on revenue generation and new opportunities there. I would say broadly, a lot of the benefits are, we're seeing this kind of two-way flow where both TradFi companies are looking to kind of sell and distribute some of their products to more crypto native institutions, DAOs, large treasuries. And we're also seeing this kind of DeFi mullet that we're talking about with Coinbase, where a lot of the more Web2 companies are looking to come on, then use the benefits of DeFi, but still provide a Web2 experience for the end clients. And so both of these are really more revenue generating drivers, but there obviously is a large cost component as well, depending on the different use cases.
Yeah, for me, I think the key is one, permissionless access, and two, censorship resistance. It's the core ethos of crypto. It's why Bitcoin was invented. It was the initial vision for Ethereum. Being able to, for anyone in the world to have access to financial rails, we take it for granted in America that our rails are really good. That is not the case in the vast majority of the world. So having, self-custody, self-sovereignty, I do think that kind of is the key component. And then there's also opportunity expansion, right? I think there's a lot of news that's been happening recently, stable coins being used as, more efficient payment rails than the kind of currently accepted traditional financial rails. I think we've seen perpetuals, right? Hyperliquid has had an amazing past year. And a lot of that is because perps as a financial product are very useful and very valuable to a lot of users. So I think we'll see a massive expansion on that market as well. The permissionless nature, like one anecdote that comes to mind, there's a team that's building a central limit order book on Monad right now. And it's 4 co-founders. One is 16, 2 of them are 17, and one's 18. The reason they got into crypto is they were trying to trade like Minecraft worlds when they're like 13 years old. They don't have you can't actually go and start trading stocks. Like there's no real way if you're 13, like that's an edge case, of course, but there's no real way to actually get access to trading stocks and getting exposure to the financial system that you currently use and you believe in. So that's how they got into crypto. They're still building this. They're an incredibly smart team. But I think that's like one use case on the permissionless side that is actually very important and will expand financial rails to the rest of the world.
Yeah, pretty much +1 to all of that. I think for me, the particular unlock when I started working in DeFi was taking interesting financial engineering concepts and making it fundamentally global and accessible. And the permissionless nature, of course, allows anyone in the world to access with an internet connection a service that they could save, borrow, trade, which prior is not fully accessible to them. We're still very early in the DeFi adoption cycle, so I think there's a lot to be uncovered. But one of the main reasons at Coinbase we believe in DeFi as the future of financial innovation is because it's fundamentally faster, right? In the traditional world, it would take weeks to get approved for a loan. With DeFi, especially if you're consumers, you get a loan in minutes. So it's 3,000 times faster. And it's also cheaper because the cost of capital when people lend on DeFi or they were to borrow, it's a lot more cheaper and affordable for regular consumers and institutions. So the efficiency, the speed, and the guarantees that it always is operational 24/7 and you can't be cheated on is something that we believe is like a level playing field for, kind of like financial products. So at Coinbase, like that's our view. We have taken a big bet with at least our consumer business to go and integrate DeFi at scale. And I think a lot of what we're trying to do is bridge the gap between, like Rahul was saying, Web 2 to Web 3.
Fantastic. So lots of things that we just talked about here. It sounds like when it comes to on-chain finance, it's about increasing accessibility, increasing speed, and just generally creating a new financial system that really helps expand access and ownership. With that being said, we're curious to understand, when you talk to your customers and partners, what are they most excited about when it comes to on-chain finance today? And what do you think they're going to be using it for and excited about in 5 to 10 years' time? Sid, would love to start with you on this one.
Yeah, I can speak in the perspective of the product I focus on because we're offering loans to consumers and providing a front-end interface that you can easily and fastly access these products. I I think like fundamentally people think in terms of cost when you're trying to get a loan. You're looking at the interest rate, you're looking at the terms of the loan, you're looking at the type of collateral that is accepted, and you're looking at like how long and like if you need to offer a credit score and other conditions needed to use the product. But when we talk to our clients, you know, it ranges from high net worth users to sort of like smaller ticket users. And typically what we hear is the fact that they like DeFi, they're excited about DeFi because it's cheap, right? And you get access to capital and liquidity instantly. So, you know, when I talk to users, and we do this regularly at Coinbase, like we want to be super customer focused. People are excited that they can custody the funds, they can get low interest rates, and they can get, you know, more than up to $1 million in USDC or capital quite rapidly. So I think from the perspective of our average retail customer, they don't really understand DeFi. They think from first principles like, oh, is this like a cheap loan? Can I access this quickly? Can I, you know, be anywhere in the world and access it? And that's our focus, right? And I think we're trying to communicate DeFi in an accessible way without having to actually explain how the protocols work or how the primitives are constructed or how the integration is actually done. And I'll get to another point, which is like around risks. And I think more than the benefits, I think people actually first and foremost think about the risk, especially because in crypto, in the lending space at least, there's been a lot of companies that have, you know, gone belly up due to a number of different factors. So when they come to Coinbase, they come for the trust, and they don't really want to know what DeFi is. They actually want to trust a counterparty that they can, you know, access financial services with. So for a regular customer, I think the biggest important factor is the fact that they can face a product and not like the actual term or the you know specific technology.
Yeah, for me, when I think about a 5 to 10 year time horizon, I think the end vision is basically a more efficient, composable version of what the current financial system is and what it allows you to do. For example, in your day-to-day life right now, unless you've gone completely bankless, which I don't think most people have, but you might have your checking and savings account. Maybe you're on Robinhood or you have a brokerage account to trade stocks, you have your credit card. I think the end vision is like all of those things can be built better and more transparently. And when you add efficiency to like the entire global financial network, like it's just like you're putting nitrous in the economy, right? Like that's actually a good thing that provides value to the entire world. So an example for your savings account, right? We have yield-bearing stable coins. You could use that as essentially your savings account. You're probably getting a better rate than whatever Bank of America or JP Morgan's offering anyways. Larry Fink has talked a lot about tokenizing equities and bringing those on chain. So if you can have your savings account, you can buy and sell stocks or crypto directly on chain. And then finally, payments, I think, is the key final piece. You have all your money, and I know Coinbase has done a ton of work on this actually, in integrating direct USDC and crypto payments into normal merchants that people want to use in their day-to-day lives. Privy just got acquired by Stripe, right? They're obviously making a massive payments play. I think once you can save cash and get yield on it, you can buy your stocks, you can buy your cryptos, really whatever financial products you want also exist on chain. And then you can also pay from the same system, and it all works in this composable, self-sovereign way. I think that's what everyone is basically building towards, right? And each person picks their own niche, spends a lot of time on making sure that their area of focus is as good as possible. But when you have a permissionless, open source, decentralized network and everyone is pushing on that, eventually you get up to the point where it's as efficient as traditional, as kind of the traditional rails for doing all these actions. And yeah, once it's all under the same hood and you own the entire thing, I think that's the key vision.
Yeah, and I think jumping out what people have mentioned, you know, generating yield on stable coins, maybe that interesting if you live in the US. But if you think of like LATAM and other places, a lot of them like holding US dollars, but for them to get yield on US dollars is actually pretty difficult, right? Like it's really hard for them to buy like a US high yield ETF in a way that it's very easy for a lot of us to. And so I also think that there's a big kind of global accessibility element. And I just wanted to use a very specific example there, where to the extent that you can generate kind of low to mid single or high single digit yields, that's really attractive for a lot of people just in the world broadly. I'd also talk a little bit about this new product that we launched, the Levered RWA product, which we did in partnership with Apollo and rolling out a few new partners in the future as well. But the fundamental idea is that there's this Apollo tokenized fund that exists, yields about 9%. You can put it up as collateral on Morpho and then borrow US dollars against it and then use those US dollars to buy more of the tokenized fund or use it for anything else. And so the end result for the end client is that you go from an unlevered yield of, say, 8 or 9% to more like 13, 14, 15%, depending on how much leverage you're looking to take on. That's a pretty huge unlock, right? So if you're in TradFi, what I just explained is a very common, almost boring product, which is just back leverage or NAV financing. But that process to get back leverage or NAV financing is typically only reserved for the largest institutions, typically very difficult to get and at not great terms and not great execution. In DeFi, you can essentially take the exact same concept and offer it to customers with much better terms, typically lower borrow rates, much more liquidity than you'd normally get, much faster, and just at generally much better terms than you'd get. And so, it is the RWA is for accredited investors, so I don't want to act like you can put $5 in, but just the general idea of being able to kind of open up accessibility to a lot of these products, and not just the product itself, but kind of additional products on top of it to a much broader swath of the world, I think is what gets our clients really, really interested, both on the investing side and the RWA issuing side.
Perfect. So obviously it's fantastic to talk about all of the exciting developments, but we also want to understand the other side of the coin is when it comes to growth, what challenges do you foresee for on-chain finance and how do you anticipate that will ultimately solve some of those largest challenges? And Kevin looks like he's thinking really hard. I was going to start with you. So let's hear it.
Yeah, I think the biggest impediment is kind of the obvious one, right? If you have to set up your mom with a wallet and you're like, keep all of your money in here. And if you lose the password, now you're broke. Like there's kind of a lot of tough things for average people who are not in crypto all the time to wrap their head around. So I think two things will happen. And then the final state is somewhere in the middle where usability starts to look more like the traditional financial way. So like you sign up with an email, like you need to make it user friendly enough to where your mom doesn't have to like laser engrave her private key and like on a piece of metal and like bury it in the backyard, right? Like that's obviously not something we can do. But I think as like apps like Privy, for example, that's an awesome way for anyone to onboard and be able to have access to their funds without needing to go through the extreme kind of private key example. At the same time, maybe this is a little bit of a hotter take, but I actually do think as opportunities that are only possible in crypto become more prevalent, people will actually just get smarter and they'll learn the system. So on one path, you're getting easier access and making it much more user-friendly. On the other path, people are actually learning what crypto is. I don't know, if you are storing your life savings in something or even some meaningful amount of your financial life, you will want to understand at least some of it, right? Right now, you sign up for a bank, you keep it in there, and you basically have an understanding that like, all right, this really big firm with a bunch of money keeps my money safe and that's fine. When you take more ownership of your own finances, like you will want to know, okay, well, you're almost incentivized to learn more about it. And so I think people actually will get smarter over time as crypto becomes more mainstream. At the same time, you have really smart teams making it accessible. And then equilibrium is probably somewhere in the middle of those two things. But I think we just need to see those two converge.
Yeah, I mean, I'll fully back up that hot take. Another analogy that I use is there were people who were going to like China in the late 80s and early 90s and like setting up factories and stuff. And that was also very, very difficult to do, right? Much harder than figuring out how to set up a self-custodian wallet with much more risks and personal risks as well. But the reason they did it is because there's a huge economic upside to getting it right? And so I do agree that I think in finance broadly and just life broadly, if there's kind of large enough rewards, I think people will figure out a lot of the risks. So I do actually agree with that. I think we have like ton of smart people in the industry and people working for a lot of the technical solutions. Maybe just from my seat, I would add, I think regulatory is really, really important. And I know that this has also been kind of said and promoted. And I think there's been obviously a shift for the SEC for what it was even a year ago. The SEC right now is much more supportive and responsive and communicative. But there's still a ways to go. And it's more that I would say the negative pressure has been taken off, but there still needs to be some kind of like positive regulation to make people, especially larger institutions, feel really comfortable in deploying assets on chain. So I think we'll figure out I think we'll figure out the technical side. Not to downplay it, but I do think there's enough smart people in crypto to figure that out. I'm a little bit more worried about the regulatory side. If you kind of ask me 5 or 10 years from now, let's say crypto didn't work out, what would the reason be? I don't think it's because we didn't build the best tech. I think it's probably just the regulators that couldn't get that.
Yeah. The other thing I think is relevant to our summit here is security. We take that pretty seriously at Coinbase. We secure billions of dollars in customer assets. And when you integrate DeFi, given the permission nature and open access, it opens up a lot of threat vectors in terms of protocol security. And you guys are doing great work at Spearbit and Cantina, but a lot of our focus and emphasis at Coinbase, especially for the integration we did with Morpho, is like we went through like multiple sets of audits, and we take that very seriously in every integration that we do. And it's a lot more cost and overhead for us to do that, but ultimately it protects customer assets, right? So I think for DeFi to scale, security, not just in terms of like smart contracts, but overall operational security matters too. For most regular consumers that are walking with millions of dollars in a wallet on their phone, if Bitcoin were to sufficiently get bigger, pretty much like you're a walking vector of attack, right? So I think for regular consumers to understand the threat that's at them is like a pretty important, I would say, impediment to the industry scaling. And then from a usability standpoint, like 100% agree with Kevin. Traditionally, like using DeFi, I mean, I remember like 2020, 2021, it would take me like 13 steps to even like open a trade or open a loan. We've basically dumped it down to like a minute in like 2 steps, right? I'm actually making it even more simpler in the coming months. And that's a lot of engineering effort, right? So any consumer team that's building apps in DeFi have to think from what does the user want and how can they interact like they would on their bank account or any other fintech app. And I think the usability argument is like super, super important. Otherwise, we can't scale to millions of users.
100%. That usability conversation and how we are trying to innovate on Web3, but still creating accessibility in the way that Web2 users are familiar with is definitely very important. And that is into the next question, which we talked about. What are your customers and partners excited for? But going off of that, what are we currently not doing on chain in the finance world that you anticipate in the next 10 years is going to be commonplace, something that we do all the time on chain? Rahul?
Yeah, I'll show the stuff that we're doing, I guess. So I think 2 big things is, generating stablecoin yield on chain, I think, again, is a really big unlock. Someone understated of how big and important it will be, not just for the US, but much more broadly. And so, there's a lot of fintechs who are kind of interested in providing this service. We've already partnered with a few of them. We'll likely partner with a few more later. And so I think that's something that's not actively being done. There's a lot of stable coins and just US dollars that are sitting in savings accounts that don't need to just be sitting in savings account, that can go out and generate yield for the end user. And going back to the levered RWA product, right? I think that there's just a lot of opportunity to use these borrowing and lend markets in crypto that are not actively being used by both crypto native and more DeFi native folks. And I think a big part of that is just education, just kind of letting people understand both worlds, right? So helping the crypto people understand the TradFi world and portfolio allocation and how to think about, why would you want a private credit allocation in your totally crypto portfolio? And on the other side, for people who already know what private credit is on the TradFi side, getting them more comfortable with the crypto rails and the assurances that we have there, et cetera. So it's kind of a 2-way flow.
Yeah, I can go next. I think it's sort of underrated, but if DeFi is going to go global Emerging markets are very important for product market fit, especially because at least in the US or EU and other more developed markets, we already have good financial rails. So most of the people in the US that use DeFi are like high net worth investors, or what we call whales, who basically maximize yield. But that's not like a legitimate consumer use case. It's more a trader mindset. But I think the real people that need access to DeFi are in Africa, LATAM, maybe places in Southeast Asia. And one fundamental blocker in these countries is regulation, but also trusted fiat on-off ramps. In a lot of these places, people still use P2P markets to buy crypto. I would say like less than 1% of people know how to do that, and they're taking a lot of effort to figure that out, and a lot of risk too. For example, in markets like India, when you're using P2P on and off ramps, your bank accounts can get shut. So crypto is not even ready for the mainstream until we solve the initial on and off ramp. So at least wearing my Coinbase hat, I think a lot of what we're trying to do is take the necessary steps to even just get people into crypto first, and then expose them to DeFi. And the existing people that are already in DeFi, which is a small amount, already have their ways to get it. But I think for us to scale to 1 billion people, we need to solve the first step, which is like, how do I get access to crypto in a safe way?
Yeah, I'll build on the access point. I think maybe my short answer would be tokenized US stocks is one massive thing that will bring a lot of people on chain for the first time. Access is kind of the key thing here, where like, again, we take it for granted. You can go sign up for Robinhood or open a brokerage account and just buy and sell US stocks. Like everyone in the world has seen the S&P for the last 50 years. Like they obviously would love access to US equity markets. And it's just very hard for a lot of the world. Like the vast majority of people can't just go on and buy US stocks. I think that will be one major thing that people see. Oh, I can actually do this action that I want to do. I just need to use crypto to get there. They will go and learn. They'll see how to do it and then actually get access. And then I think at a fundamental level, DeFi is kind of like 3 pillars, right? It's like spot, lending, and then derivatives are really perps now. I think in a similar way to where, like when credit was kind of invented and actually became mainstream, like it was kind of hard to know what would happen to financial markets with like this new invention of credit. And it actually made the markets go pretty insane. I think when you have composability between your metaphorical checkings and savings, your brokerage and payments all in one place, there will be a lot of kind of efficiency unlocks that engineers will build in, where right now you might have a bunch of money sitting in your checkings account and it just kind of sits there. I'm sure that people will build out ways to basically just increase the total global capital efficiency of the world. And I'm pretty excited to see what that looks like.
Amazing. Okay, so we've got time for one more question. So we're curious to understand, where do you expect the power balance to land between traditional finance institutions who start creating on-chain teams and on-chain divisions versus crypto native on-chain financial institutions? And what do you see as the benefits of either? Sybil?
Yeah, I'm definitely biased on this, but I can keep my answer short. I think when I was working at different startups in DeFi, the biggest hunch, at least in the US, to offer these products is the regulatory climate. And of course, we were in a different jurisdiction then. Is how do you legally sort of structure products to make it more mainstream? And I think joining Coinbase, one thing I learned really well is the relationships that we have with regulators, and how that is very instrumental to even offering DeFi products, because ultimately they're just financial products. So I kind of started taking that more seriously. So anything that we do in on-chain, even though it is on-chain, of course, it has a different structure to it. Having the right licenses or the right approach is, I would say, like the safest way to build a business in crypto.
Yeah, I think probably traditional financial institutions grab a ton of power in crypto across the board. I think the more regulatory clarity that comes out, like big firms see how much money you can make in crypto. They're going to come in and eat. Their teams are going to be smarter and ship faster. And like they just come in and eat markets. That's what they do. They're the best in the world at that. I think the key is in those regulatory gray areas. That's where crypto natives will really excel and succeed. They'll build products that they're not really sure if this is legal yet, but it definitely is useful. And then it's up to governments to decide if that's something that they want to bring in, like stable coins, and promote and make massive winners out of, or if it's something that they're like, no, this is illegal, and then it gets shut down. But yeah, I think that gray area will always be dominated by people in emerging tech and the crypto natives.
Yeah, and I would broadly agree. And I would really think of it as I think the crypto natives are really, really good at execution and a little less good at distribution. And I think TradFi firms are the opposite, very, very good at distribution and a little less good at execution. And so obviously you need both. And so I think there's going to be kind of symbiotic relationship between the two of them. I think probably the example of the best M&A deal in history was Facebook buying Instagram, where Instagram had great execution by like a 10-person team, so not great distribution, but Facebook had all the distribution and they didn't create Instagram, so they had to buy it. But I think being able to buy Instagram also helped both Facebook and Instagram get much farther than they would have gone alone. And so I think we'll see very similar symbiotic relationships where big TradFi companies will leverage their distribution networks, purchase companies that can that can execute really, really well, and then superpower both of their growth, and they can go much farther and much longer than they would have otherwise.
Well, we're looking forward to finding out how this plays out over the next couple of years, but I appreciate everybody's time and attention, and I appreciate you all for sharing your answers. We'll transition to the next event.
Thank you.
Thank you. Appreciate it.
Our next panel will focus on the current regulatory landscape and the institutional challenges facing broader adoption. Please welcome Devin, co-founder and executive director at the Uniswap Foundation; Maya, who runs payments at Solana; Jake, co-founder at Cantina; and Matt, founder at the venture department and former executive deputy superintendent at the New York State Department of Financial Services.
Awesome. It's great to be here. I get to do these regulatory panels at least like once a year, and normally they're extremely dry, and I have typically bad news to cover. And then also, it's normally with 3 lawyers. So for both of those reasons, I'm excited to do this panel. You'll see these are definitely not just 3 lawyers that we have here. And we actually get to cover some positive news for the first time. So without further ado, we'll start. Maybe Matt, we'll start with you and do some intros. If you could share, your background and what you're working on now.
Yeah, well, thanks, Jake, for the opportunity to be here. My name is Matt. I'm a twice former regulator, actually, former federal regulator with the FDIC, and then former New York State regulator. And in that role was the primary supervisor for a lot of the largest exchanges and custodians in the U.S. And now run an early stage venture capital fund called the Venture Department. And we've focused on stablecoin infrastructure, tokenization, and DeFi.
Hi, I'm Devin Walsh. I'm one of the co-founders of the Uniswap Foundation and currently the executive director. I've been in the space for, 8 or 9 years at this point, and I've seen up close and personal, not just in Uniswap, but in some other roles I've had in the space, some of the frictions, obstacles, the millions, tens, hundreds of millions of dollars that have been spent in the wake of regulatory uncertainty and legal risk. And it feels like a massive burden is in the process of being lifted across the industry as a whole, which I think is very exciting, not just for us at Uniswap, but across DeFi as a whole. So excited to chat through that a bit more today.
Hi, my name's Maya. I work at Solana Foundation, focused on payments globally. So we're working with top payment companies, remittance companies, anyone who's really touching payments, to be honest, which is everyone, to help them think about how they're embedding and can leverage stablecoins. So, for example, in the last hour, we announced that Pfizer is pushing its stablecoin strategy on Solana. And so, yeah, very excited. Prior to this, I built an on and off ramp, an OTC desk in emerging markets. So I'm very interested and always excited to think about the duopoly and the relationship between US regulation and how that impacts global behaviors, because this is a global ecosystem that we're working in.
Awesome. So topic du jour today is really stable and the market structure bills. So we'll cover both of those to start, and then maybe we'll get into some of the more interesting future landscape of the regulatory space. But to start with stable, so Matt, stable just passed the Senate. Could you kind of talk us through like what that actually means and where it goes from here?
Yeah, for sure. And I think you're referring just to stablecoins generally, because stable is the name of the bill in the House, and then Genius is the bill in the Senate.
That's why I'm not a lawyer.
Stable Genius, yeah. But so yeah, I mean, this is an area that people have been working on for a while. I mean, particularly the House of Representatives. I think probably everyone here has kind of followed it on crypto Twitter. A big monumental thing that it passed the House on a very bipartisan basis. I think it was 68 to 30 or something like that to vote, which is really great. And so now, passed the Senate 68-30, and now it goes to the House, and the House has the option to pass the same bill or to pass a different bill. If they pass the same bill, then it goes to the president for the president to sign. If they pass a different bill, then it has to go to reconciliation, where the House and the Senate agree to, negotiate on a bill, and then it had to be revoted on by the House and the Senate. So that's kind of the status of things. And I mean, just a couple other points of color to add is, the president has said just last week, I think on Wednesday or Thursday or something like that, said that he wants the House to pass the Genius bill as is, without any add-ons. But we also know that the House has been working on this a lot longer than the Senate. So I think they have some pride of authorship, and they feel probably like, well, we're just not going to, we have our own views on what it should be. There's also, there's also some that feel like they should combine this with market structure and pass them together. So those are some of the things that are being considered at the moment.
And so, Maya, you've worked on the on and off ramping side. You've worked in this industry very closely. Could you maybe break down what actually is in Genius? Like, what does the bill look like, and also what does that enable that didn't happen before?
Sure. So I'm actually going to cover two, which is the Genius Act and the Stable Act, because hopefully it's a Genius Act that is passed. It's kind of looking that way, but I think it's important to be aware of both. So the Genius Act was created by the Senate, and that is what got the supermajority and is now going to be debated by the House last week. Whereas the Stable Act originated from the House. And broadly, they cover similar things, right? So in terms of who can be an issuer, what, how we think about backing and pegging stable coins, etc. But at a high level, the Stable Act is a bit more prescriptive. So whether that is in terms of being very prescriptive about what can back or underpin a stablecoin and ensure that it's pegged to the US dollars, is more prescriptive on that. It's also more prescriptive on the relationship between federal regulation and federal level regulation and state level regulation. So whereas the Genius Act says that, okay, if the market cap of a stablecoin is less than 10 billion US dollars, it's for the state to determine the regulatory landscape, as long as it's roughly the same as a federal regulatory landscape or expectations. The Stable Act is a lot more prescriptive and says it almost has to meet or exceed the standard that we have at the federal level. So that's one of the key differences that kind of comes to mind. And on top of that, both say that they don't allow algorithmic stablecoins. The Stable Act is more prescriptive in saying that. I think the Genius Act is a bit open-ended at the moment, if I remember correctly. And then the other important nuance is that both say that stablecoins cannot issue yield or interest to users. And that is really, really important from a crypto native perspective. Now, the second part of your question was, what does this actually mean for
what does it enable that we don't see today?
So this is really important because we've kind of been living in the dark, right? And this kind of sets the standard of what we know we need to adhere to. And in my mind, that is really important from an industry perspective. It helps to ensure that So for example, especially as you're engaging with more traditional financial players, they're really concerned about how do we make sure we're compliant. We now all know what we're actually being compliant to, because before it was guesswork. We were just hoping that this is roughly the benchmark or where the benchmark would be. I think the other important thing is it helps to shape how stablecoins should be created. So as I said, yield-bearing stablecoins or stablecoins that provide interest aren't allowed. And that's really important in terms of how you think about structuring a stablecoin if you are a stablecoin issuer. And it also broadens who can be an issuer, right? As well as specifies it a bit more in the sense that banks can be issuers, non-banking institutions that are IDI compliant can be issuers. This is really, really important when we think about the mass adoption of stablecoins and who the issuers of the futures are going to be. Because it's not just going to be Circles, Paxos, Tethers of this world that are issuers. It's going to be the likes of a Fiserv, as we've heard today. It's going to be the likes of even potentially a Walmart, right, who is exploring this. And that's really important. For that to happen, we needed this regulation or some form of clarity.
Awesome. So maybe Devin, from like the protocol or the foundation perspective, and then Matt, I'll go to you from the investor perspective. But what activities do you expect to see coming out of this? And then, are there any exciting use cases that you hope to see?
Yeah, I think speaking to the first part of that question, I think of the fact that there's now more legal certainty and the ability for more trust and confidence to come from issuers. So when I say issuers here, I mean, some of the large financial institutions, or even, like a Walmart or a Pfizer, like some of the big institutions who may act as issuers. Developers and applications who might integrate assets issued by the issuers, or integrate, hooks or some of the, stablecoin focused AMMs or DeFi infrastructure built not only by Uniswap or Uniswap related developers, but other DeFi applications out there. And then users, most of all, who might, people in this industry have a short-term memory, but who might look to the Terra devolution, recently and say, hey, stablecoins, I don't know, if I trust this thing. They can now know at a bare minimum, there are rules of the road that regulatory enforcement agencies can look at to, not, outlaw everything, but actually identify, the benefits of DeFi, who's abiding by common sense, rules that look to consumer protection, things like that. And so I think we'll have, more trust and activity from not just all of those players, but by folks who are talented and who want to create compliant applications and who want to participate in and use applications which, abide by those regulations. And I think to the second part of your question, we're already working with and seeing teams build not even proof of concepts, but applications which kind of bring compliance on chain. So one of the areas that that the Uniswap Foundation is very excited to fund grants within and to support developers building are applications and infrastructure similar to something we just funded with a team called Predicate, which is building an on-chain compliance engine. We recently gave them a grant to work with Paxos to build a hook infrastructure focused on USDL, which is a yield-bearing stablecoin. So as Maya mentioned, this technically falls outside of the stablecoin bill, but I think is a good example of what can be brought on chain. Just mentioned it falls outside of the stablecoin bill. So it actually, what Paxos wants to is aiming to achieve through this infrastructure is geofencing, such that users can only use it if they're located outside of the US. So that is, one potential benefit of having, more clarity is, at least, okay, this falls outside of the bill, can't be in the US. But if you're an issuer, how do you ensure you're being compliant and actually able to leverage some of the benefits of on-chain infrastructure, such that you're not, stuck using off-chain infrastructure and applications, not really getting all the benefits of DeFi. What Predicate has built is an engine that basically checks that whoever is trading on-chain USDL or providing liquidity for USDL is based in the US. They actually, check the IP address of the user every time they are swapping or interacting with this hook. And I think that kind of infrastructure that's able to look at regulation and actually bring that on chain is extremely novel. It is somewhat uniquely enabled by hooks on Uniswap. And I think it will open up the ability for, TradFi users who want to interact with these apps to actually take advantage of the benefits of DeFi in a safer way.
And I just note that you guys have a white paper with Predicate.
Yeah. You should all look it up.
Everyone should look at it. It's excellent. Predicate's a portfolio company.
Oh, amazing!
I'm excited about that as well. But so one of the biggest impacts. So you might be wondering if you're watching this, right? Like Circle just went public. We already have like legally permissible stablecoin issuers in the U.S. So why are we talking about why is stablecoin legislation even needed? I actually think it's a good question. I won't get into it because I think maybe it's actually maybe not as needed as other areas, but it is the way I think about the benefit is that it gives just permission for a broader set of actors to enter the space, as people have talked about. And I think that will be, in terms of what are the implications, what are the opportunities, I think that is one of the biggest, is that I think what happens in a post-Genius world is that stablecoin issuance is no longer a startup game for the most part. I mean, maybe for non-US stables. I think for US stables, the issuers that win are those with trust, scale, and distribution, right? And so that part of the ecosystem, I think, becomes dominated probably more by people that have some existing, volume and kind of larger incumbents. I think that the opportunity for startups then shifts to other parts of the stablecoin stack, which are probably more interesting anyway than just issuance. But issuance is kind of really about risk management. One big notable thing, right, with Genius that was talked about is that it bans yield, which I think is unfortunate. But I think that's sort of like the price of getting a compromise from both parties. But that doesn't mean yield's going away, right? I mean, we know markets will find ways to meet needs, and so. One kind of thesis I'm sort of personally interested in is a view that in the future, I think it's possible that sophisticated users in this space, traders, institutions, et cetera, may actually only hold stablecoins like at the moment of transaction, and that's it. And that otherwise they'll hold tokenized versions of their risk-free assets. So like a tokenized treasury fund, tokenized money market fund. I think that's one implication, is that you're going to see greater fungibility between cash and cash equivalents, so that even if stablecoins are non-yield bearing, move seamlessly between these different instruments.
So one more question on stablecoins, Maya. With the U.S. kind of leading the regulatory charge for the first time, is there an expectation that other countries will follow and will adopt similar laws, or would it really just be like, hey, if you want to interact with U.S. consumers, these are the laws that you'll have to follow, and we don't really have expectations that a France or, a India will adopt similar things?
I mean, to be fair, there are some other jurisdictions in the world that have already issued regulation, right? So I think it's really important to recognize that the Genius Act or the Stable Act, whichever is ultimately passed, is foundational and fundamental for the US, and it does have a wave effect, right? It kind of legitimizes stablecoins and crypto in a way that we needed as an ecosystem, to be honest, because it tells other countries that, hey, this is something we actually should be seriously investing and paying attention to. However, with that being said, I think it'd be amiss to suggest that other countries weren't already doing something in terms of regulating stablecoins. So one of the biggest examples is always going to be MiCA, right, in the EU. there's of course also the fact that the likes of the Philippines, stablecoins have been legally accepted as a form of payment since I think 2017, 2018. There's markets around the world that have been doing stuff with stablecoins in different forms. They have different nuances to their regulation, but I think it'd be rather amiss to suggest that no one else is doing anything or has done anything. In terms of what this does mean, as I mentioned, it does re-emphasize the importance of having a stablecoin strategy. And what we have seen is that now a lot of traditional players, whether they're in the US or abroad, are, especially more in the US in my opinion, are now more seriously saying we need to have a stablecoin strategy. Whereas perhaps before they're like, maybe we'll experiment, maybe, we'll have a little innovation team who's dabbling around. Now they're seriously doing it. And it's the CEOs that you're speaking to. Whereas before it was maybe one person who was, hoping that someone would listen to them. So that's been the shift in my experience.
Can I mention one thing?
Yeah.
I think that there's a huge opportunity for banks. I think it's like easy to discount banks, right? And say like, well, they're just so slow moving, which is true. But I also think over the last 4 years, right, there's like a lot of pent up interest in banks to get involved in this space, and they've seen what's happening. And so I've had conversations with a number of banks recently, not just like large banks. I think large banks may engage in issuance. I think smaller regional banks, like an obvious thing for them to do, for example, is to just enable stablecoin deposits and stablecoin withdrawals. And imagine that, right? Being able to like have, I think it's possible there's a world where every bank account is mapped to a wallet, right? And just like a bank account may be mapped to a Zelle address today. I think that will happen probably pretty soon with at least like an initial set of quick movers in that space.
Maya?
I think from my perspective, if we think from a US-centric perspective, where I see this going is there's a lot of companies that will be using stablecoins increasingly in the background, right? Especially if they're doing any form of cross-border payments, right? It helps with from a treasury optimization perspective alone. I do see a world where end users in the US do perhaps engage with stablecoins, but I think that will come first, especially if they are doing some form of cross-border payments, so whether that is remittance, whether that is payroll, distribution, etc. In terms of then just someone who in the US just holding US dollar stablecoins, I don't see that happening until we have other forms of tokenized assets. So whether that, which I mean, to be fair, we already do have in some form, but a greater distribution of popularity. So whether that's tokenized money market funds or I don't know, whatever. But I think one thing I always implore people, because when you're sometimes thinking about stablecoins from a Western-centric perspective, it's hard to understand, well, what's really the benefit, right? Where it really makes a difference is when you're moving money abroad. And I'll give a personal example. When I lived in Hong Kong, this is before I was like alive and ready for the stablecoin, so I was using Wise. Wise is still a great product and company, definitely. But when I was living in Nigeria, the only way I got money in and out was via stablecoins. Like I depended upon stablecoins. And there are plenty of other markets where that's increasingly been the case. Now when I'm sending I was buying a gift for a friend in Hong Kong, I sent her money via stablecoins because it's just quicker, cheaper. So really think more from a cross-border global money movement perspective, because that's where you really see the utility right now. And it has been there for a while already.
Yeah, it's easy to forget about the global frontier when you're in the US. Like I'm just excited about the Dunkin' Donuts stablecoin. But hopefully that is just a small one in the greater ecosystem.
Is that happening?
It's certainly going to. So we'll move on to market structure. Stablecoin legislation seems necessary. Market structure legislation to me seems exciting, but there's nuances to it. So the Ag Committee just passed the market structure bill. Matt, I believe it's called Clarity. Yeah, got that one right. So that was 47-6, which is 1/5 or 1/6 of the body itself, which is significant. So Matt, maybe briefly you could just kind of break down like what is the meat of this bill and what is exciting about it, and why does the industry seem to like this one more than some of the previous attempts to do something like this?
Yeah, well, I can lay out some of the general contours, and I'm sure my co-panelists have thoughts too. But I think this is it's a little bit harder. I mean, stablecoins I think are pretty straightforward actually. Like it's not that complicated to figure out how to regulate stablecoins. And, market structure is like a lot harder, and because and speaking as like a former regulator, I don't think you want to be too prescriptive too soon, right? Because if you don't really know, you kind of want to see how the market evolves a little bit. And so I think that I think part of this is trying to strike the right balance. Like some clarity is needed, but you don't want to be so prescriptive so that you overly kind of influence potential outcomes. And I think we've seen this in other markets, right? When other countries have done it, like regulated too early. But what does it do at a high level? Like one of the main points of any market structure legislation is to clarify the jurisdictional boundaries between the CFTC and the SEC. What's a commodity? What's a security? And so one of the notable aspects of the clarity piece of legislation would be to do that, and importantly to kind of define what is a digital commodity, and to separate the transaction involved in selling that item, which may be a securities transaction, from the underlying asset itself. So that's really important. It would also create a pathway to becoming a digital commodity. So say we know that projects often start a little bit more centralized because that's how humans work, right? It's hard to start something at scale, decentralized from day one. And so it creates a pathway to maturity, and it defines maturity. And basically what it means is decentralization, right? And so you can start as being, within an SEC regulated context, with new rules, bespoke rules for the sector, and then graduate to the CFTC if you reach that level of maturity. It also creates some exemptions for DeFi actors like validators, developers, et cetera, to carve them out from this. So I'll pause there. But
yeah, I guess I can maybe speak to a bit how this is beneficial and very exciting for some of the developers out there, not just for Uniswap, but
well, before I get there, just to set the stage, I couldn't imagine a better person to be asking this question to. Uniswap, by some definitions, is market structure in crypto,
yes.
Right? So you have a token. The platform is all about transacting tokens. Yeah, I would love to get your thoughts on just, what does this mean for your organization? What does this mean for other organizations that interact with you in crypto in general?
Yeah, I kind of can't stress enough how difficult and in some ways really like impossible the period of regulatory uncertainty and antagonism made it for organization. Like I'm sure you guys at Solana can relate, but certainly at Uniswap and US based organizations, like the few that did choose to incorporate and work in the US, like how impossible it was to navigate that in a way that didn't entail just shutting down, moving totally offshore. And so just really cannot underscore enough like the benefits that clarity and certainty bring to developers, not only at Uniswap, but again, the most recent upgrade of Uniswap is really like a platform based upgrade. So it allows hundreds, thousands of developers to come in, like add their own spin on an AMM, which could be compliance focused, like what Predicate has built. It could be focused on other kinds of asset classes. It could be focused on, like providing better execution for a particular kind of market, whatever it may be. The fact that, this bill begins to, it really like legitimizes DeFi without trying to wrap it in old school TradFi rules. It really recognizes it as something that is separate, distinct, has things that improve upon TradFi rails, like that in itself, like are things that we have not had in Congress, like and across like the regulatory landscape. The fact that there are rules and regulations which provide consumer protections in that realm, I think are huge. Again, I think like every time there is a Terra type collapse that is bad for us all, that like is a bad mark across the industry. And what else? I think I think that seeing more kind of like on-chain compliance tools like Predicate, which begin to like incorporate some of the compliance frameworks that we're seeing passed in these builds on chain will open up more issuers, developers, and then users to actually coming on chain.
So for the sake of time, I want to move along and kind of look at like what might happen here. Maya, maybe I'll start with you. If we get stable or genius and then we get clarity, what's next? Are we done with regulation? Do we need anything else? Or will the regulators keep regulating? What would you expect there? What do we need positively, and then also what possibly might come down?
Oh, I mean, look, the regulators will always exist because if they stop, there would be no need for them. So there will be more regulation because, of course, this is still a relatively young ecosystem. And so there's going to be a lot of learnings that will keep coming to the fore, and regulators will adapt and respond to those. In terms of what's next, I think what will be really, really interesting is to see how US-based regulation will start to interact with regulation in other markets, right? Because, as I said, one of the key points of utility is this cross-border money movement. So what does that mean from a compliance perspective as a business that's facilitating that? If, for example, you're doing money movement between USD to AED, for example, in the UAE, what are the different compliance landscapes and how do you navigate that? How do you navigate, for example, this regulation with capital controls? What does that mean in different markets as well? That's what I think will be really interesting, because whatever truly happens with US dollar stable coins and whatever regulation comes to the fore here will have global ramifications. And in reality, the main players currently, or the biggest use case so far, or until the traditional players really start to come in to the fore and into the ecosystem, is being held by people around the world, and mainly people outside of the US. And so that's what I think is going to be really interesting. And honestly, only time will tell. If I knew, I'd probably be placing some bets financially, personally, but I'm not sure yet.
Yeah, I think another area, this is about, where we want to see future regulation, right? Yeah, I think that an area that we haven't discussed that I would like to see more focus in the future is DAOs. And just to kind of frame, like, why do DAOs need regulation? You can look to it, and the reason I care about this is the Uniswap Foundation, we focus on governance. So governance, happens through the Uniswap DAO. We care about this because if you look back to just recent legal precedents for BZX or the Uki DAO case, basically a ruling interpreted BZX DAO as a general partnership, which means that everyone who has participated, and there are different kind of interpretations of what participation means, in that DAO was viewed as a general partner, and thus they have joint and several liability for all economic liabilities and legal liabilities that may be thrust upon the DAO. That opens up a lot of risk to participants in DAOs, in the US. And that matters for Uniswap because the Uniswap Treasury, whose disbursements are voted on by the DAO, funds a lot of development and maintenance and upkeep of the DAO. So if you look at recent laws which were passed or are in the process of being considered stateside, so Wyoming recently passed the DUNA. So this is a legal wrapper specifically meant for DAOs. It stands for Decentralized Unincorporated Nonprofit Association. Texas is considering passing, a similar kind of legal entity which could be incorporated for DAOs. That these recognize DAOs or would wrap DAOs in a specific legal entity structure, which provide limited liability, amongst other benefits, to members of DAOs, while maintaining a lot of, the core underlying principles of, anonymity, credible neutrality, decentralization that make DAOs important and distinct. And so I'm very excited to see more federal consideration of DAOs that, introduce the same kinds of things, legal protections for participating in DAOs while maintaining, while not just trying to thrust upon, old rules for how you consider entities upon them. That would introduce, vectors of central control, but actually maintain decentralization.
The three scariest words in policy are joint and several. So if we had 15 more minutes, I would dive into on-chain equities, and I would love to do that. Maybe that's a topic for another panel. For now, we're out of time, so thank you so much for joining us, and we're going to
Thank you.
the security panel.
Thank you.
Now, next, we'll be diving into the technical security barriers, slowing down progress, and what's needed to overcome these challenges. Please welcome Joel from the blockchain security team at Coinbase, Merlin, co-founder at Morpho, Thomas, co-founder and COO at Kiln, and Alex, co-founder and CTO at Cantina.
Thank you, Mike. I just want to set the stage before we get into the intros. Crypto DeFi was kind of built out by idealists, and then all these degens showed up. And now we're trying to get retail, our friends and family, moms and dads into it, and institutions as well. So I think everything has to change in order to serve that. With that in mind, please tell me your backgrounds. Which of these levels you are at?
Is this working? Yeah. So my name is Joel Kerr. I've been at Coinbase for 4 years. My team is the DeFi security team. So we do everything related to custodial, self-custodial, lend, borrow, staking, digital asset security, essentially any sort of Web3, DeFi, financial side of it. Like I said, I've been at Coinbase for 4 years. Prior to that, I worked in TradFi. And then prior to that, I worked in key management for the Navy and other crypto-esque companies. That's my intro there. I think for me, I really care about the custodial nature, obviously coming from Coinbase, and also how we've expanded our offerings to things like different types of staking, now lending. It's very exciting. And I'm excited to see where we go from here.
So I'm Tom, and I am the Chief Operating Officer and co-founder of Kiln. We are a staking and digital asset rewards management platform. So we enable crypto businesses and individuals to access staking and DeFi rewards in a very easy manner. We have about $11 billion staked with us. I've been working on Kiln for about 5 years. So I lead the finance, people, and legal teams over there. And prior to co-founding Kiln, I was working at Circle for 2 years.
Right. I'm Merlin, co-founder of Morpho. So prior to Morpho, I was a student in computer science. We started Morpho during our studies, and now Morpho is one of the largest lending protocol out there with 6.5 approximately of total deposits. We have super nice integrations with Coinbase, Kiln, and we are pushing hard the DeFi amulet meme and trend, and also haircut. Pushing integration of DeFi and bringing it to the TradFi world, to institutions, but also to retail users that are not used to that space.
Thank you. That's awesome. I want to jump right in, actually, with you, Merlin, because Morpho started out as a DeFi product, fully on chain with the UI, and now as you mentioned, I actually want to touch base on Coinbase. You launch on Coinbase, you have this retail interface with Coinbase. What was the process from transitioning from a DeFi product with a DeFi UI into being in Coinbase? What are the steps to get there?
Right. I don't think most things have changed in terms of like releasing product and protocols. We have always been super focused on making the best protocol and thinking in terms of infrastructure. And our job is building infrastructure protocols so that everyone on top of it can build whatever they want. And we need to build those infrastructure as open, flexible, and credibly neutral as possible, so that there's no way we can prevent someone else to build like the thing they want to do. So I don't think it has changed in terms of like what we are actually doing, but it has changed the approach and our messaging around that, which makes like like conveying that message that if building infrastructure is important and we should focus on it, make all our effort to secure them so that people and institutions or centralizations or anyone like Coinbase can build real product that can scale and tap into a large distribution network like Coinbase has.
You have, I suppose, two parts, right? You have the infrastructure, which is the on-chain element.
Yeah.
And then you have the interface. Outside of Coinbase, you supply your own interface, and you have to invest into security of that.
Yeah, right. So we have our interface. I think you always, you can't build a protocol, ship it out there and say, hey, here's the protocol, please use it. You need to showcase that it has an impact, it's useful for users. You should prove to others that it's important to build it and that you can create bankable business on top of it. So that's the goal of the interface. And also, you don't have any intermediaries if you go to the Morpho's front end. So it's very important for the DeFi ethos to have this. However, in terms of UX, it might not be convenient for, I don't know, my grandma, for instance. She doesn't want to set up her self-custodial wallet and interact with Morpho through the front end. But if there's like a one-click integration on top of Morpho, then let's do it. Let's build it. And this is what we're doing. We are pushing other people to say, hey, it's possible to create awesome things on top of Morpho, like, and you can generate revenue. So let's do it. And on the security side, of course, we are putting a lot of effort on the smart contract side, but now the front end becomes also something that could be an attack vector for I don't know, like Lazarus Group or other like a state-sponsored group. And it's super important to assess like third parties, dependencies, like even APIs. There were incidents where the Lazarus was like DDoSing Kraken APIs during crash of prices, so that people could not top up their position, and on their side they could liquidate positions. So that's like an edge case that build service providers, front-end providers on top of Morpho should think about.
Yeah, before we get too deep on that side, I do want to ask you, Joel, Coinbase's position, how do you even evaluate a product? And once you get to choose like Morpho, you take over the interface basically, right? And you only consider the protocol side, or do you consider anything else?
Yeah, so when it comes to the actual product decision and who we work with, that's more of like Sid's domain, he was in here earlier, he's not in here now.
Yeah, but I mean, from a security perspective.
From a security perspective, we look at both the protocol level, the on-chain level, and that's a lot of where we worked with Cantina and Spearbit to do that. So we had those smart contracts audited. We worked very closely on that. And then when it comes to the actual integration with Morpho and the DeFi Land product, my team looked a lot into like the fund security, the amount of how you manage keys to enable those transactions. So it's not just looking at the on-chain side of it. It's actually looking at the money movement side from our piece as well. The DeFi Lend program is, Coinbase or Bitcoin-backed loans. And so we want to see how that transition from the state of, holding Bitcoin to going over to this loan format also works. So from our side, we had not just the integration piece that we considered, but actually the whole like fund life cycle and the changing of states within Coinbase as well.
Yeah, I was wondering on the actual, the security reviews aspect. I mean, as Merlin said, there would be at least two different parts, right? He has to care about the retail aspect, UI, and the protocol. And if Coinbase takes away that part, you only have to take care of the protocol.
Yeah, I mean, I think when you talk about the UI, I think the UI is like one piece of it, but there's a lot that's going underneath the hood whenever you click the, I want to have a DeFi loan and I want to take my Bitcoin and put it on Morpho and, leverage that position. And so a lot of that is what, that one click side of it, there's a lot of the actual like updating our internal ledger that Coinbase maintains. It's making sure the key management on the back end is also moving across. We're going to probably talk about it a little later on, but when it comes to like securing the keys and securing the transaction, I think that's one thing that we really have to get right. And I think that's one thing that Coinbase heavily invests in. And so when we look at like, an integration with Morpho, we're not just like considering like, oh, what do we do on the protocol level? We're actually looking at the whole, like from the time you click to the time you do the handover to Morpho, where is that chain of funds and the security of that coming through? So that's threat modeling throughout the whole process. It's doing the audits. It's working with the penetration testing teams, like more traditional pen test teams, to actually test that flow. So it's this full integration process of the Web 2 and Web 3 pieces.
Right. Yeah, I just wanted to kick this off, with the transitioning from DeFi into an actual institution. But I know, Thomas, your company really focusing on institutions from the get-go. You haven't built a DeFi product, you went straight to institutions. How was that different? What is the approach when you do that?
Yeah, definitely. So selling to institutions, selling to enterprise customers is a different approach. We see a lot of focus on compliance matters. They want to ensure that their offerings will be compliant with jurisdictions that they're operating. So at Kion, we've implemented like proactive KYC, AML approaches when applicable. We've hired a head of compliance. We also invest a lot of time in meeting with regulators and lawmakers in key jurisdictions, in DC, in Europe, in Japan, in Singapore as well. And there is a lot of value in doing this work because we help guide our customers in thinking about the new products that they'll offer. So like we working like closely with law firms, with their legal team, their compliance teams matter as well. And yeah, then like obviously like they have the same security concerns as you've mentioned, like they expect enterprise grade security. So for that, we put in place like 24/7 monitoring, working with Spirbit on smart contract auditing as well. We have like defense in depth at like at the level of like several teams, but we also think about security not only in our products and our smart contracts, but also in our wider operations. So like just like access control, obviously, but also like financial controls, like not like a single person like Kion should be able like to make a wire that's worth like $1 million. Otherwise, like you have a security risk. That's not necessarily like the first one that you would think about in crypto, because that's not the attack vectors that everyone talk about on Twitter, but it's still one. So really thinking about this as well. And then like the last expectation I'd say from enterprise customers is the support, which like retail users, I mean, they will just like email your support team when they have a question, but they don't expect a white gloves approach. So while like at Kion, we have a dedicated onboarding team, we have a customer experience team as well, with like varying levels of support depending on the importance of the customer. So yeah, I would say these three elements, they help on compliance and legal matters, security elements that we've mentioned, and customer support are really what's key to dealing with enterprise customers.
Yeah, I wanted to touch a tiny bit on the, all these different security aspects. Especially, I think the ones we have mentioned so far, key management being one of the really important ones, and that's differs for retail versus institutions. I don't think it's all for my mom, how they do key management, but maybe it's all for custody. That seems to be in a much better spot. Then we mentioned protocol security, any of the UI stuff, and the monitoring. Is the protocol actually available? I think in the past few years, most of the discussion has been around protocol security. Like all of the reviews, competitions, all of this is really just targeting protocol security. And then even the past week, we have seen a number of like front-end hacks. If you think about like CoinMarketCap, these are like not extremely serious, of course, but it shows that those are the parts maybe you have paid less attention to. How do you see, the transition from only talking about protocol security talking about everything else in security.
Right. So far, I mean, our experience in that space is looking for security companies that are really good on the Web3 stack, Web3 aspect, has been very hard for us. The reason is that like most developers are not used to that, to those. So of course there's the Web2 aspect that is like common to all like startup, fintechs, etc. But there's also how do you integrate the whole Web3 stack? How do you integrate Morpho? Smart contract, not Morpho, smart contract. I'm biased. And here the problem is you need to have people that are really good at also reading smart contracts, understanding them, and that can spot issues on the Web3 layer. And so far, I don't think that the space is mature enough to serve the demand on that front. So I think there's like a huge work of education to do on that front, and not, as you say, just the smart contract aspect. So I think this is one of the first point that as an ecosystem we should work on. Also on our side, our vision of smart contract is that it should not rely as much as possible on external third parties directly. I mean, the logic should be as immutable as possible and governance minimized, etc., so that you can remove almost all. I mean, all problems can like also. I mean, there was many DAO attack vectors. And so on our side, we're trying to remove all that aspect and attack vectors. So there's also a topic that we should try to remove as much as possible the attack vector, that front end that is broken could impact smart contract.
Thomas, on your side, because I think your company has everything covered, it seems.
So far, so good.
Is there, if you want to scale any of this beyond where we are, because Merlin, you also touched on it a tiny bit, which of these parts of the security stack are the biggest risk to scaling this?
So I think Merlin really covered well the protocol smart contract side of things. So I'll focus on something else. You have security certifications, like operational certifications such as SOC 2 Type 2, ISO 27001. I think these are like the base level of expectations, and this is what's expected of you when you deal with enterprise level customers. But you need to be aware that this by no means is an assurance that your smart contract-based products or that your security is going to be sufficient against attackers, especially state-level attackers. So what we do at Kiln is we have many other security measures in place, such as penetration testing. We have bug bounties in place for several of our products. And I think generally it's also about building a culture of security and paying attention to attack vectors within the company. So it's a lot of training. It's a lot of just being a parrot about that. And so now that Kiln is more at the forefront of things, we see more attacks coming in. And so something that I'm very happy about is seeing the people at Kiln constantly bringing up threats that they've seen, either false alarms or real ones. So yeah, I think creating an environment where people feel safe, coming up with these issues is extremely important. Otherwise, you could have a risk growing up. Obviously, you want to supplement that education by tooling. So companies such as CrowdStrike. But also, as you scale, you start doing what's expected of a larger company, like constant monitoring of your IT devices, the upgrades. I know that's frankly goes without saying for a large company, but a startup that initially was 5, 10, 20 people, just everyone was bringing your own device. So I think coming to the realization that at some point you need a head of security, you need a security team, you need to go through these old boring processes is actually table stakes.
On that note, Joel, Coinbase has scaled several times. All these 10x's. What are your key advices protocols should really take on?
It's like a pun, right? Because key advices, right? Yeah. Before I get onto that, I do want to say real quick with Kiln, you mentioned that like more regulation around like SOC 2 type stuff is going to be critical. I think a lot of like, as we talk about like safe custody when it comes to custodial products like staking, like demonstrating not just that you can put in controls like access control and like protections on the key, but also like making it publicly available where it's like we have a SOC 2 type of certification that protects our validator infrastructure to prevent any sort of key theft, and slashing is going to be really critical. As far as like the scalability and adoption pieces of it, I mean, really, I think what makes Coinbase a special, I guess, is our custodial product. That's what most of the retail users come for. It's what the institutional customers come for. At Coinbase, we have a lot of different key management solutions on the back end, which I know we don't publicly disclose all of that. We have a very rigorous process of how we sign transactions, how we protect keys at rest, how we like secure them from a cold storage perspective. And I think when you're really looking at getting into this space or capturing customers, you really want to look at like ensuring those keys are highly protected, highly secured. And like I mentioned a second ago, like you can demonstrate that publicly is critical. If you can't do that, then it doesn't matter what digital asset you buy, how you integrate with it, if the key and the transaction security could be moved without consent or with high degree of confidence.
Is this actually, it would be a different question, but is this actually something institutions look for, kind of like an audit log and seeing everything, what is taking place?
I would say absolutely. I mean, I think a lot of institutions want to come in, and when they move a lot of money into a company like Coinbase, they want to have a high degree of confidence, not only in the thing that they're investing in, but also in the person holding their funds for them. Coinbase does a lot of institutional deals, not just with large financial banks, but also with Web3 and protocols and all of that. We have an extensive partnership with them where we go through our security controls. We go through our not just the controls themselves, but our review processes. What we look at when it comes to like the DeFi, digital asset security side of it, the blockchain integration side of it, certainly the key management side of it. And so we're seeing a lot of that, and that's a lot of what I support on the like institutional, like how can you demonstrate a high degree of confidence that you'll safe custody our funds.
I mean, this applies to you as well, Thomas, but I do wonder to Merlin, any of these questions in regards of traceability, logs, what applies to a protocol like Morpho in that sense?
Right. So for a protocol, it's quite, I would say it's easier in the sense that logs, etc. You have everything on chain. The code is on chain, etc. So in terms of auditability, it's way easier to prove that, hey, here's the logic. We have done all those audits, etc. It's much easier to prove what has been deployed and what people will use when they interact with that specific address, that specific smart contract. So on that front, it's way easier. But the goal is now, how do you prove that, okay, you have you pass those audits, but what is the firm that you've been working with, like Spirit, etc. Those firms are maybe not known yet. I mean, Spirit is known now by institutions, but that does not mean that all institutions know about security firms and security companies in the space. I think there's a lot of also what's Thomas, you mentioned that the Kiln team was overall very security minded, and I think you feel it when you discuss with a team, and you have this sense of, okay, they have thought about everything, etc. And so also it's like discussing with the partner and trying to clarify all the points that they would where there are fears, and you just remove those fears by explaining how it works, educating them, describing, explaining how the protocol works, and also taking time, maybe jumping in with the team into the code, answering questions. And it's constant support that you show that you have think through everything, and that you prove that you know well the protocol that you've secured. So it's just the end state. Of course, there's like this Swiss cheese model that you need to apply to make the protocol super secure. We've published the security framework that we use for the previous protocol, and I think it was really, this is something that we also share with people in that space, and that is being used by other companies in that space to how do we secure a smart contract, how do we secure a protocol, and you have all those steps. Of course, some might not have the funds to do them all, or they have like maybe different approaches, but at least having a framework and a given approach to secure a smart contract can also make the things much clearer for people that will integrate it at the end of the day.
I think we touched like on most of these questions already in terms of what institutions would ask for. You really went down into they want support, they want the certifications, they want all the information at custody. Is there anything we didn't mention on what institutions would ask for?
So I'd say that I think one critical thing that we're pushing with Morpho is if you integrate with Morpho, for instance, you own the whole stack. You don't rely on third parties. So Coinbase that is integrating, this Power product on top of Morpho. Users are borrowing against CBBTC to get USDC loans. So the one specific market is integrated on Morpho. This market, the risk parameters, everything cannot be touched by the Morpho team or the DA, anyone. Nobody can do anything about that market. So that means that, it's fully permissionless, fully non-custodial. There's no third party involved. And I think this is a critical thing for institutions that want to integrate a protocol. They don't want to rely on a third party. And if they do, that means that there's even more legal and legal requirement that they must comply, and that can complexify a lot the integration. So that's, I think, one thing that we did not mention. So yeah, I would say like immutability, no third party reliance.
Thanks. I would also add that something else that institutions are waiting for is like more clarity on the regulatory frameworks, because like obviously like technical concerns and security concerns are slowing down adoption, but nowhere near as much as the uncertainty of how the SEC or the CFTC are going to qualify your products. And so that's something that's like definitely in play at the moment. Like the Genius Act has just passed the Senate. The Market Structure Act is being drafted. It's kind of like a topic of contention. But yeah, like recently the SEC came up with like clarity about protocol staking, publishing a note saying that they don't view this as being a security, but obviously like there would be much more comfort from the side of our customers and prospects if this were to be passed into law as part of the Market Structure Act. So I think as players in the crypto industry like Coinbase, Kion, Morpho, we have a duty to go educate policymakers, lawmakers, regulators about what we are building and be very honest about the challenges, the risks of it, but also the benefits for the US customers and how it will improve welfare for everyone.
Joe, do you have anything to add we missed on security?
On the security side, no. I mean, I fully agree with the regulatory side of it. Coinbase has a very aggressive approach there. I do work with our legal team quite a bit, and I think that's something that I'm very excited to get more clarity in the future on.
Thank you. I want to close with one last question. Quick answer from everyone. What is your key advice to new builders in getting into security and secure products?
Yeah, it's really tough. I mean, my number one advice is, I know I mentioned it before, but the transaction security, ensuring that the user intent matches what happens on chain is critical. Everything from the time they say, I want to send money here, to it actually being broadcasted. If you cannot do that well, you should really revisit your security controls.
Yeah, on a more high-level abstract note, is be humble. If you brag about your security practices and you think that you are not prone to failure, like you might be in for like a not so good surprise. So yeah, be humble, share learnings with other teams, learn from other teams as well, connect with security researchers, lots of organizations. I mean, it's, you can only win by doing that. Like there is no value in keeping security practices for yourself.
I'd say when there's a doubt, there's no doubt. It's borrowed from the recruitment side, but I think it really applies to security in the sense that if you have a doubt about one, like in your transaction flow or in your code or something like that, that means that you haven't worked enough to make it safe enough so that you can like sleep at night and just deploy and say, I'm sure 100% that this thing is secure. If you're not sure 100%, that means there's a missing link, that you must fix.
Those are all great advices. Thank you all.
Thank you.
Thank you.
Now it's time for our first keynote. Please welcome co-founder and CEO of Cantina, Hari Malakal, who will be talking about more in depth our new Web3 SOC framework, which is being used to measure institutional security readiness for protocols.
Hello, everyone. My name is Hari. I'm one of the founders and the CEO of Cantina and Spearbit. I've been building in this space for a while. I used to be at the Ethereum Foundation building the Solidity compiler. It's a piece of code that you have to make sure it's secure. Otherwise, billions of dollars would be on the line. And I fundamentally believe, like talking to a lot of our customers, institutions, the banks, that crypto is at a big inflection point today. It's very clear that crypto is about to onboard trillions of dollars in assets for the very first time. And just stablecoins alone is expected to bring $2 trillion into the blockchains. But if you really ask the question, is crypto and more widely crypto products really ready for this level of institutional adoption or capital? It's a very hard question to answer. Just last week, I was talking to a leader in the crypto industry who came from the TradFi world. He's very excited about the opportunity of onboarding trillions of dollars just in stablecoins alone. But at the same time, he's also very worried that crypto is not ready for $2 trillion on chain because of primarily security. And we hear that concern a lot of times when we talk to these large asset managers. And this is one of the reasons why we built Web3 SOC, which I'll get to in a minute. But I want to tell you a story, from almost 2 years ago, which I would say is a precursor to what we're doing today, which is one of the CFOs of a asset manager or an investor reached out to us to understand one of our security audit report. So right now, what's standard for these? Right now, what's standard for understanding risk is what's called like a security audit report. More broadly, it's just a review of your code base, oftentimes smart contracts, by some security professionals. Surprisingly enough, this CFO read one of the audit reports of our customers and wanted to know more by talking to us before he deployed a lot of their capital into this protocol. He wanted to make sure that they're doing the right thing and wanted to know more. We ended up working with this person, and this was a very successful engagement for all parties because they ended up deploying tens of millions of dollars into this protocol. It's been very safe since then, and it was a win-win for everyone. The CFO was able to get on-chain yield safely, and this customer that was working with us was able to get more capital into their protocol. And I would say that this incident could be considered as the precursor to a lot of the work we're doing today, because a lot of institutional and traditional asset managers have the same questions before they work with a crypto product or a crypto protocol. They want to understand what risks they are getting into before they deploy hundreds of millions of dollars or even billions of dollars. And Web3 SOC was built to address some of these concerns in a structured way. So there are 4 different evaluation points that we use. The first one is operational risk. These are things that sounds very simple, but are very important. For example, who is the team that is building it? Are they legitimate actors in countries with strong rule of law, or are they North Korean hackers? You'll be surprised at what's happening in the industry. Another important aspect is the governance. Let's say you deploy hundreds of millions of dollars into a protocol. Maybe it's safe today, but is it safe in 2 weeks? Can the team behind it rug this hundreds of millions of dollars? Is there a governance process that can override some of the actions? These are very important questions that large institutions want to know before they deploy capital. As an example, even if the protocol is decentralized in some capacity, institutions feel more comfortable knowing that there is a time lock to governance process. So they can understand that, hey, there is something about to change in 2 weeks. I can make a decision in the next 2 weeks on removing my money or keeping it there, depending on what's about to happen. But if the protocol team or a set of actors can unilaterally remove money quickly, that is a very hard no for many institutions deploying capital. Another question or another category we have is called financial stability. And there is a very typical question that large asset managers ask: is this protocol Lindy? And what they mean is, does it have a history of having no downtime, having no security risk, having no crazy governance attacks? And this is important for institutions to build trust and for them, before they deploy capital. I would also say that another interesting risk which follows in this category is counterparty risk. If you are building an automated market maker, you want to understand who you're trading against. Because in certain jurisdictions, you cannot trade against North Korea, for example. And these are very real questions. You want to understand your counterparty, the person on the other side, is a legitimate actor. And the next category, is security. And as a somewhat security-oriented conference, this needs no introduction. But there are questions like, has the smart contracts or the backend code base or the front-end code base, have they undergone independent security reviews? Which, fortunately, today, a lot of protocols and teams are doing it. But these are important questions that we have to look into. And I also don't want to forget about Web2 or traditional security risk. Every week or every other week, we hear an incident where their DNS is compromised. Perhaps one of the supply chain is compromised. Even last week with CoinMarketCap, they had a supply chain issue where a malicious actor was able to inject a pop-up asking the users to connect. And if you connect your wallets to this pop-up, you lose money. And finally, the last category is what we call as regulatory risk. This includes questions like, is your code open source? Because if you look at some of the bills that are being passed today, this is one of the requirements. And we expect the regulatory category in the Web3 SOC to expand over time, because there is clearly a lot of interest, especially in the US and in the EU, to clearly like regulate what does it mean for example, a company to be decentralized. This also includes things I mentioned earlier that's connected. For example, who is your counterparty? Is it a set of trusted actors, or is it North Korea? So with all of that said, how can you use Web3 SOC today? If you are an institution, if you are an asset manager, if you are an investor, if you're a venture capitalist, you can understand you can understand like what kind of products you want to work with and what risk you're taking in by looking at their Web3 SOC score. For example, some of the customers here, Morpho, Kill, Uniswap, we did an assessment for them and they are enterprise grade, which means that if you are a large asset manager looking to deploy billions or even trillions of dollars on chain, these are products that you can trust, and these are like on the leading front when it comes to crypto security and more generally like crypto compliance. Finally, if you are a crypto product that's looking to onboard these institutions or billions of dollars in capital, you can understand how you can level up your internal security posture by looking at the components of the Web3 SOC. This framework is going to evolve over time as we work with more and more customers, understand from regulators on their needs and such. And our goal is to make it open over time. If you have more questions, I'm happy to answer either here in person or reach out to us through our website. To learn more, you can go to cantina.xyz/Web3SOC. That's it. I'll probably take one or two questions, but otherwise I'll be around if you have any. Go for it.
I mean, this isn't the first, rating system that a security company rolls out. I've seen quite a few. What do you think will make this one stick with institutions? Because almost every audit agency has something like that. Oh, we're going to give you a gold. We're going to give you a silver. We're going to give you a bronze. They imagine that will lead to higher confidence, but at the end of the day, it's just someone putting down a rubber stamp. So what's going to make Cantina different?
This is a great question. And first of all, I would say this is not just by Cantina, but Cantina working with a lot of industry-leading partners. We have people like Kill, Morpho, Uniswap, and there are even more people that we haven't fully announced yet, but you will see in the next few weeks like who we are partnering with. So this is a standard that we built working with all these different organizations building in crypto. It's not just by us. And the second thing is timing. There is a really big regulatory unblocking in crypto, which allows a lot of US institutions to work with crypto companies. And this is a need that we are seeing every day. We talk to these institutions and they ask us, hey, I want to understand this company that I'm working with. Is that really institutional grade? Because at the end of the day, these large institutions, what they're selling is trust to their customers. If you are, a big bank, Bank of America, you can be trusted to. If I'm a customer of Bank of America, I'm not worried about losing my dollars like tomorrow. Whereas you can't really tell the same thing about a lot of crypto protocols today. I have to be constantly alerted if something happens. So we are seeing a real need, and we talk to a lot of these people, and it's really timing and the partners we are working with. They all want this, and we are solving a real pain point. We're not trying to come into this by saying that, hey, you need this. We are rather building it for our existing customers and solving real problems.
Thank you very much. The question that I have is specifically on institutional security questionnaires that you get in order to onboard and engage with those institutions. How often do you see that they're adjusting their own security questionnaires to truly understand Web3 risks? And also, how do you actually respond to Web2 risks that maybe we're not focusing on and not unable in many cases to respond to?
This is a great question. And I will start by answering the Web2 risk first. This is a lot easier for institutions because there are existing standards and expectations that they have working with Web2 companies. So they are expecting almost all of that. To give one example on what a lot of crypto companies don't do today, crypto companies do not have a really good incident response process today. And while talking to a lot of our customers, they are really leveling up their incident response plans, working with us in some cases to really get to a point where it's just, it's expected. If you are, working with a bank, you understand that if they have a compromise, they have a set process to follow to limit the exposure. A lot of crypto companies are going through it today, and I would say this is more of a Web2 risk and Web2 expectation. To answer the earlier question on how the institutions are adapting, I am very surprised working with some of these institutions where they are also genuinely trying to understand how to assess crypto. And both the crypto companies and these institutions are both trying to meet each other's needs. One great example of this is the Coinbase product there's a Coinbase product with Morpho, but at the same time, there's also the Coinbase product with Uniswap, which is called verified pools. So if you, for the very first time ever, if you are Uniswap, which is a automated market maker, you can exactly provide what's called hooks that allows, that defines who are the people allowed to trade in a certain market. So if you are an institution and only want to trade with verified users, KYC individuals or even other institutions, you can use a Uniswap hook to specify that. And you only have to deploy your capital or trade against these pools. So Coinbase built a product working with Uniswap for institutions. So we are learning that both sides are learning things together and building products and adjusting their own risk as well. So I never imagined, maybe 5-6 years ago, an institution would use Uniswap, and a regulated institution, but we are getting to a point where that is already happening. So I'm very excited seeing that both parties are willing to make amends with each other. If there are no final questions, great meeting you all. Thank you.
All right. Without further ado, to wrap up presentations for the day, I'm excited to introduce Austin Adams, founder of Whetstone. He'll be talking more about how he's focused on accelerating capital formation within the crypto markets.
Perfect. Just talking to this thing. All right, wonderful. So I'm Austin Adams. I am the founder of Whetstone Research. We're sort of like a venture protocol product studio. We don't really have a nice market thing, but we sort of just try to build interesting products that we think will accelerate the future of how financial markets are set up. So the first one I'm going to talk about is capital formation in the year 2025. And before I founded Whetstone, I did protocol research at Uniswap Labs. So I did a lot of early Uniswap, V3 and V4 and Unichain. So particularly familiar with how decentralized markets work and how capital formation them happens. So this is I'll do the intro, but I wanted to talk about how did capital formation in crypto, how has it happened previously? So these are sort of the 6, I would say, different types of how capital formation is happening. So there's the early mining days with Bitcoin, with the fair launches. Then there was ICOs, which was a particularly problematic time for regulators, but there was a lot of capital that enter the system. And then IEOs are sort of like what users do today with the initial exchange offerings. So they're trying to make sure that like you can deploy on an exchange and users can come trade them. That sort of seems like to be the prevailing narrative today. And then we have airdrops and DeFi, and then finally sort of like the fair launch. And we're going to talk a lot about the final one, which is sort of fair launching. We think that like that's an interesting new thing that like only exists in crypto markets right now. So this is the number of tokens that have been created by a platform. And so we can see that it's like pretty much only up and to the right. There's been like more tokens created this year than there has ever been. And a lot of them are in different ways. Like sometimes they're companies, sometimes they're memes, sometimes they're rugs, sometimes they're like art and things like that. And the one thing that's interesting is like this chart only keeps going up. As you can sort of see, like it was pump, and then we sort of saw this growth in other platforms and other asset classes that grew as a part of like this fair launch system. And so we've seen like this chart is only going to continue going up. That's sort of what we think in general. And I want to talk a little bit about like how does that sort of overlap with TradFi IPOs. So I didn't talk about this at the start, but I used to work at the Federal Reserve. I did a lot of like market research there. And it was particularly interesting to me that like IPOs in the US and IPOs abroad are actually very inefficient. So we've sort of seen this structural decrease in how many IPOs are happening every year. So since about the 1990s, 1980s, there's been fewer and fewer IPOs as people, due to like regulatory costs, it's harder to have specific reasons to IPO. Like the marketing benefits are lower, the costs are higher, the benefits are much smaller from like private credit and things like that. So we've seen just structurally fewer companies IPOing. We've seen larger and larger unicorns. And so we've seen these like crazy large private companies like SpaceX and Stripe and someone else, I would say. And so this has sort of led to this problem of like, why aren't these companies IPOing? And the big reason is that like, it's actually like really expensive to IPO. I think this is like something people don't really talk about. So this is the average cost of IPOing and sort of like since I think 1980. And as you can see that it's like pretty much flat and it's never changed. It's always been 7%. And we've seen this like structural, none of this has changed. We've sort of seen like there's fewer and fewer underwriters who are doing IPOs. We've seen fewer and fewer companies IPOing. We've seen the costs stay the same. And over this period, trading costs on centralized exchanges and sort of TradFi exchanges has collapsed. So the cost of trading on any exchange has sort of dropped by about like 85%. And so during this period, there's been no change in how much does it cost IPO, but we've seen this like structural collapse in how much trading costs are. And it sort of begs the question, like, why don't we see why is this number not going down? It sort of seems like a number that should be going down. And the reason it's pretty much because underwriters don't want it to go down. That's like, they say this pretty much. They say like, hey, we don't really want, we want this to not be commoditized. And so we were like, okay, if you don't want it to be commoditized, like maybe we should commoditize it then, because then it will sort of lower these things. So this is thinking of a better model, like what would be a better type of asset class? What would be a better type of IPO? It'd be on-chain native. It means that like anyone in the world can trade it. Anyone in the world can see it. Anyone in the world can access the same amount of opportunities. It would be globally available. So like right now, only like very limited amount of underwriters can take part in IPOs, which causes like a cartel issue where like it's hard for anyone to bid up the price. Self-underwriting is something we think is very important. Is like, how do you make it so that you don't have to like talk or know a bank to get an IPO? And the customization for all these sort of new asset classes, as we think, are particularly interesting because right now the only person who really IPOs is like mega large companies. There's not like small businesses. There's not like medium-sized businesses. It's pretty much like you're a mega, a multi-billion-dollar company and you're IPOing or you're just not going to. And that's actually like very different than like in the 1990s. Like Amazon like didn't really have product market fit when they IPO. They were very new. And that's like structurally very different than today, where like it's the only people who are really doing it are large entities. This is what we work on. I guess I'm coming back to my own shill, which is I work on Doppler as our first product at Whetstone, and it's an entirely programmable liquidity bootstrapping model. We can sort of imagine that you can build custom markets for custom tokens. So we have made almost like 1.5 million assets to date, which is like far more assets than have ever been created on like the New York Stock Exchange and things like that. And we do this by having this like open source, heavily audited smart contract protocol that anyone can put assets into. And then we sort of deal with all the pricing mechanisms. And we do the pricing mechanisms through a lot of different ways. But the biggest way that we do this is through this on-chain market. So we put, just as like the previous speaker was talking about Uniswap markets, we create a market on chain for anyone to trade inside these markets. And what happens is the world gets to come together and price these assets. If you think the price is too low, you can buy it. If you think the price is too high, you can sell it. And when everyone sort of comes together and trades them, you see that like we have very high quality price discovery. And so we've priced almost 1.5 million assets to date. It's all automatic. It's all very cheap. And some of these assets range from like, sub cents to, we have one that's like $15 million right now. It's using the same mechanism. And so what that does is you have this like breadth of assets that are all being priced automatically and very cheaply. It's so very cheap to use our markets. And so we've seen like a lot of people start using them. And now we're audited by Cantina, which is very cool. We're live today on a bunch of different chains. We're live with an open source SDK, so anyone can use ours. And right now we have, so this is our current ecosystem. We have, how many is on this chart? There's 9 of us on this chart. No, there's 8 of us on this chart. There's 8 live integrations using our protocol. And so some of them are doing like content, some of them are doing music, some of them are doing real world assets, some of them are doing like real companies. And so what we've seen is an explosion in new types of asset classes. I think particularly something that I'm very interested in is like, if you get rid of the ability, if you make it so that anyone can IPO, then you have the ability to build these new types of asset classes that allow people to capture value for those specific things. And so we're particularly proud of like Zora is pricing social tokens. They've made like 1 million tokens. We have Coop Records, who's a lot of very famous music artists, like EDM artists, and what they're doing is they're tokenizing their assets. They're putting them on chain, and then anyone can trade them. And we have our own interface as well. And we particularly are excited about there's a bunch more that are coming, but we think that like in a world in which like anyone can get liquidity for their assets, high quality pricing and high quality liquidity for their assets. I think the world looks very different because we're going to have a lot of new asset classes that haven't existed before. And it's particularly something that I think like is completely new and completely unique and completely powered by crypto. And so this is our sort of like website. We have like our white paper, we have the our Twitter, we have the website, and I guess you can follow me along here for Austin and Adams, and I'm happy to sort of take questions. It's only the last 5 minutes for questions, so perfect. 5 minutes. Questions? No questions. Perfect. Yeah, it's in relation to the gross spread. So it's like how much, if you raise like $100 million, they take 7% of that. So they take $7 million. And so on Circle's case, I think they raised like $2 billion. And so underwriters took $140 million from them. A lot of money.
How do you protect in this? How do you protect in this situation the creation of market structure on the back end? So making sure that when this prices, it prices to all of the not correct, but beneficial users that keep up the price and will actually transact?
Yeah, so I think that is, I think like you're like referring to like MEV bots getting in very early, like increasing the price a lot and then dumping on retail users. We have a different mechanism for how we do initial early pricing. So we it's functions like a pretty traditional like batch auction all on chain. So what happens is like users come in, we look at we look at how many users are coming in. We have some expectation of the amount of amount of tokens we expect to sell at each period. And if people are buying much more than we expect, we increase the price a lot. If the people aren't buying enough, we decrease the price a lot. And so what occurs is essentially these sniping bots have to have an accurate assessment of the price. If they buy and their assessment of the price is wrong, they actually lose money because the auction will decrease the price on them and they can't sell back risklessly. And that causes we're essentially trying to make sure that like if the sniping bot is the best at pricing these assets, like that's good for them. Like that's like just like what a market maker or like a liquid fund does. But they can't just buy everything early immediately because otherwise they lose money.
What if they have? So like what happens in current systems, right? Like So my background is I was in investment banking for 15 years. The reason those IPOs suck and what happened to Circle is basically the large hedge funds forced it to be that way.
Yeah.
They came in and they said, this is the price. We are willing to give you this amount of money only for this price.
Yeah.
And you can take it or leave it. And that's a big reason why the amount of IPOs has gone down is because they say, look, if your fair value is X, I want X times 0.6. And that's what I'm willing to pay for you. Otherwise, you don't get access to really liquid markets. And so the question is, let's say Web3 becomes this becomes extraordinarily successful, and this is the exact way that we end up.
We're hoping, baby.
What really stops the big hedge funds from coming in and doing the exact same thing and saying this is the correct price?
Yeah, I think the problem is like it's a cartel behavior, right? So like if you are the N+1 hedge fund and you know that the price is at 0.6, whatever it is, it's like 60% of it. And you can make money by buying it. You can be the one who balks. Like there's money to be made immediately, right? And the way that these cartel behaviors are enforced through like IPOs, like the syndication, right? Like you just pick whoever you're only going to pick people who trust you. And I think the benefit of these like on-chain markets is that like it's globally accessible to anyone by default. And so no matter what happens, like you just need one person to balk and be like, I will buy. And then the system works as expected, right? And I do think that like one of the benefits of being global is like you just need one. And so we think that the cartel behavior breaks down a lot when when anyone in the world pseudo-anonymously as well can buy, right? Like you could be fake JP Morgan or something like that. You can buy and make money. It doesn't have to be under your current name. And so the pseudo-anonymous nature of this sort of breaks this cartel behavior down a lot. And we've seen this with like a lot of other markets as well. Perfect. I guess we're out of time anyways. I ran up against it. So that's all I have. So, yay.